Okay, let me break down why the US dollar's current situation is way more fascinating than most people realize. Here's the thing, the dollar isn't just another currency right now, it's caught in this insane tug-of-war between momentum and exhaustion. Think of it like a sprinter running at full speed, but tripping over their own feet. That's the dollar heading into the Fed's big meeting. And honestly, this isn't just about interest rates or inflation, it's about psychology, positioning, and the hidden cracks in global markets. Let's start with what everyone's talking about, stretched positioning. The dollar's been on a tear recently, right? But here's the kicker, traders are so crowded into buying USD that it's becoming a self-defeating prophecy. Imagine if everyone at a party decides to wear the same outfit, it's no longer special. That's what's happening here. Geoff at BNY nails it when he says the dollar's strength is built on a house of cards. Cross-border buying, like foreign investors snapping up US assets, has been the backbone of this rally. But guess what? That demand is starting to look like a Ponzi scheme. When everyone's betting on the same outcome, even a tiny shift in sentiment can trigger a stampede. Personally, I think the most underrated angle here is the hedging dynamic. Foreign investors have been slashing their dollar hedges at a rate that feels almost reckless. Why? Maybe they are complacent about US assets, or maybe they are just chasing yields like it's 2021. But here's the problem, when markets get rocky, as they always do before a Fed meeting, those same investors panic and rush to hedge. It's like ignoring your car's maintenance until the engine starts knocking. And get this, even if they don't actively hedge, falling stock and bond prices automatically increase their exposure. So the dollar could get a mechanical boost regardless of intent. That's the kind of nuance most headlines miss. But let's zoom out. The Fed's been telegraphing its moves for months, right? So why does the market still act surprised? The article argues that only a blatantly hawkish shock from the Fed could reignite broad dollar buying. But wait, if the Fed has to shock people to move the needle, doesn't that prove the market's already priced in every possible scenario? It's like trying to start a fire with wet wood. The Fed's tools are losing potency because traders have over-anticipated every move. And the EUI example is brilliant here. Even when a central bank acts tough, the currency doesn't cooperate if positioning is stretched. This isn't just economics, it's behavioral finance in action. What's wild is how this ties into a bigger trend, the death of safe havens. The dollar's supposed to be the go-to asset in crises, but if its rally is stalling because of speculative excess, what does that say about global risk appetite? Maybe investors are so starved for yield they are ignoring traditional safe assets. Or maybe the era of the dollar, as unchallenged king, is finally ending. If the Fed can't even push the dollar higher without a shock, we are looking at a fundamental shift in how markets price risk. So here's my closing thought. The real story isn't about the Fed meeting next week. It's about how markets are starting to question the dollar's dominance in ways we haven't seen since the 2008 crisis. The stretched positioning isn't just a technical quirk, it's a symptom of deeper structural changes. And if you're watching this thinking, but what about the economy? Slow down. The dollar's fate now hinges on psychology, not fundamentals. That's the hidden layer most analysts aren't talking about. What's your take? Is the dollar's crown slipping, or is this just a temporary wobble?